All right. So before we get started today, um, just a couple things before we get going. So first of all, someone made me aware, the recording from yesterday. So those of you who are live probably doesn't impact you a lot unless you want to go back and kind of review what we did. The YouTube upload got stuck and I didn't realize it. So it was sitting there with an error. And so I think I fixed it. It should now be showing up. I'll double check again after class just to make sure it didn't have any issues again, but it should be posted now. The class recording that's replacing tomorrow, so it's just review, that one posted fine. So I'm not sure exactly what went wrong with the in-class one in terms of what it flagged. Um, but that one should be up after class today as well. A couple more things. So that quiz three due date is passed. So I'll change it so that you can view that today. But I also put up I had some people ask about a couple questions. And so one of them, so really all three of them, the issue was, you could have deduced it from the question that was asked, whether it was talking about short or long run. There- But if you interpreted it as long run, even though I meant it as short run, some of the answers could vary a little bit. So for most of them, it was like a fill in the blank. So it didn't impact a lot of the parts of it, but it maybe impacted one part. So just to be fair to everyone, I did give credit as long as you submit. I think it was 14, 18, and 19. So I've updated the scores on Canvas, and then those will kind of get posted. Um, so if you're going back to review them, I updated the language of those questions, and made sure that the answers were consistent. And I specified if it was long or short run in the ones where it wasn't 100% clear. So that was a better version of the types of the phrasing that you would see on the exam. Once again, I don't want there to be, it was somewhat implied in those problems, but I'll be more specific on the exam in terms of, even if it mentions it in an earlier part, specifically mentioning that the next fill in the blank is the short run or the long run. Instead of just because I've mentioned short run the first time, assume that you knew it was going to be that the second time. Um, so that study version I have kind of under that quiz three materials. I would kind of use this one as you're thinking about preparing for that midterm exam, which is on Friday. And then I will move these materials, the practice problems down here into midterm number two, just so you kind of have them all in the same place to make it a little bit easier in terms of the Canvas interface. So the only thing else that should be due over the next few days is that quiz four it's set to release after my second section today at 3:30. So that's going to be due by the end of the day on Thursday. Right? So you'll have to kind of get on and complete that. Once again, I mentioned this yesterday, but you won't be able to see the answers, but you can see which questions you got right, and you can see the questions once you submit it so that you can use that as a study tool. And then practice problems four and three, you can use those to study as well. There was, I think, two questions that had I've changed a little bit in quiz four. So if you're using an old version of that, I would kind of look at the new version once again, just clarifying some of the language. And I think the one I said increase and it was supposed to be decrease. I think it was question 14. So I've got that updated for using that to kind of study for quiz four and for the midterm. And I'll get to the chat here in a second. Um, and then I also posted, where is it at? Oh, I thought I had it posted here. Well, we'll add it right now. So this up under the discussions tab, but I want to make sure that you can easily find it. So this is going to be related to material that we're going to cover today. So the relationship between taxes, saving, government spending, and real interest rates. That discussion is not due until the end of the day, Tuesday next week. So you can work on it this week if you have additional time. I would maybe focus a little bit more on studying for that exam, and then either Friday afternoon, over the weekend, Monday or Tuesday, kind of work on completing this Canvas discussion. So kind of similar to the last one, it's got three different questions, each with kind of a follow-up. So I'm giving you different AI prompts. Primarily, you're creating graphs and look at the relationship between two variables that we'll be discussing today. Sometimes you're going to have to choose, right? AI will either choose for you or it will ask you follow-up prompts in terms of, for example, what you want to use to represent consumption taxes or what variable exactly you want to use to represent savings. So usually you're kind of mentioning these in your initial response. You will then have look at two other students' responses to 1A, 2A, and 3A. You'll choose two of them. So maybe this would be like I gave you an example. You choose someone's post and then you look at their response to 1A. You respond to that and compare it to what your answers were for 1A, right? And then you might choose question three from another student, look at their response for 3A, and then respond to theirs, comparing and contrasting kind of your answers to theirs. Okay. So 5 points for each response, 10 points for the initial post or your initial response to my questions. I also, as part of this, you don't necessarily have to include the graphs here, but you at least need to mention what they're showing you about the relationship. So it's probably easier just to kind of post that picture or graph that it gives you. And then it makes it a little bit easier to kind of describe what that relationship is kind of with that graph as a reference. Okay. And I'll get to the questions here and then we'll kind of return if I can get my, there we go. So as mentoring going to be similar to the quiz, the majority are allowed to print the quiz questions, answers to use during the test. So all you can have out during the exam is going to be blank paper to write on, um, or any written class notes. So printed versions of the quiz won't be allowed. So if it identifies that's kind of what you have in front of you, it'll flag it. Um, Now you could have, and ultimately, if you took notes on those, that's fine to use those. So if you want to take notes on kind of those old quiz questions, you can do that. Um, so yes, in a way you can, yeah. And then what will it look like? And I'll post an announcement um, later this evening about the details of the exam. Actually, I'll probably hold off until tomorrow just to kind of make sure I'm seeing that everyone got that locked new kind of proctoring service to work correctly. If you haven't, please reach out to me via email. I can see that some of you have already submitted that, so you must have got it downloaded and working correctly. But I want to make sure kind of the majority, hopefully everyone responds to it so I can see that everyone got it working correctly before Friday. And then I'll post an announcement more about the specifics of the exam along with that. So it's going to cover module 5, 6, 7, and 8. It's going to be look like those old quizzes. So there's a lot of fill in the blank. There's a lot of select all that apply. And there's a lot of just numerical formula-based questions. So it generates different values for everybody. Um, different modules, there was more of that than others. So like this module that we'll be covering today, not a lot of formula-based questions. But from like module 7, right, when we had like consumption functions, excuse me, there's going to be a lot more like calculation-based questions. Okay. Any other questions on that? And I think we'll have a little bit of time at the end of class. If you have more questions on what the exam looks like, I might revisit that just to kind of give you a little bit more of an idea of what I would do to study, etc. So you mentioned this Canvas discussion. I mentioned the due date of that fourth quiz. Um, those daily quizzes, right? Always do 2 days after. So we currently still have two available. So this one, even though we don't have class tomorrow, it's still due at the time that we would have class. This one is due at the time we're going to have class on Thursday, which we still will have a live class session on Thursday where I'm essentially just doing review. Any questions you have over any practice problems or the old quiz number 3, that's a good time to ask them. And then today's quiz will be due before we start class on Thursday. Am I getting my dates right here? Yes, right. And then I'll put up a daily quiz for tomorrow, and it'll be due before the exam starts. It's going to be um, a very easy one. I basically am just going to give you a couple questions that might be good to review. and I'll tell you the answers in the daily quiz. So that should be an easy one. It's more of just still making sure that you're logging on in terms of logging on here. It's not a live session, but it's watching that class recording and answering questions that look similar to the ones that I went through. But as long as you're getting on, that's essentially going to be effort based. All right, I'm going to give you the answers in those problems. Okay. Any questions on that before we jump into material here today? Okay. So, and if you think of any more, I think we'll have time at the end today. We shouldn't take the full class time, I don't think, but we'll see. Um, so we left off, and I kind of introduced this idea of national savings. So national savings we kind of had was rearranging our GDP function. We're going to assume a closed economy for everything we do. I'm not going to introduce net exports here. And we're thinking about the overall investment that we have in the capital or the savings in our economy is going to be our GDP minus consumption minus government spending. That's essentially what we have left over to invest in the capital. But here, when I subtract taxes and add transfer revenue, that's what's going to private individuals. And then the taxes that are generated and the transfer payments that the government is spending, that's captured in this public savings, which we then said anytime I reference public savings, whoops, and on the previous slide, budget surpluses and deficits reference not national savings or private, it's just referencing public savings. So even though we kind of added this different form of the equation in, we really haven't changed anything. It just allows us to differentiate between national and public savings. The actual national savings, these two approaches should give us the exact same value. Okay. So we'll work through some questions that we could see here. So what would the level of private and public savings be, and what would national savings be if I had the following values? Okay. So if I'm given this information, I've got GDP, we can think about notated typically using Y, is 800. We've got consumption is 400. Taxes are 120. Transfer payments are 700. And government spending is 140. So one way I could do this is if I wanted to find national savings, that should be GDP minus consumption minus government spending. So here we would have what? 800 minus 400 minus 140 should give us, what am I looking at here? So 540, so 260, right? Now, if I wanted to break this down into private and public savings, private savings should be GDP minus consumption minus the taxes that people are paying plus the transfer revenues they're receiving from the government. So here that would be 800 minus 400 minus 120. Wait, did I get transferred? No, sorry. This is not 700, this is 70, right? Thought that looked a little weird. So 70. So if we do this math, we what? 520, 350. So no, what I want here, 400 minus 150, 520. This should be 350. Okay. Now, if I wanted to calculate public savings, that should be the taxes the government generates. What was the average class score for exam one? Sorry. So I'll get back. I don't know that off the top of my head. So at the end of class, I'll kind of look that up for us. Okay. Let me close this out so I get alerts for the thing. So taxes minus government spending minus the transfer payments they're making to individuals. So this is going to be 120 minus 140 minus 70. So this will give us what? Negative 210. So negative 90, if I'm doing math in my head correct there. Okay. So we can break this down into public and private savings. What should be true is national savings is going to be the sum of those two. So hopefully if I've done math correctly, those two values should add up to how we calculated national savings up here, which sure enough, my private savings were 350, public savings were 90, and I get that same value of 260. Okay. Any questions before I add some things to this? So if I asked you here, is the government running a deficit or a surplus? Well, basically, if public savings are above zero, this would be a surplus, right? They have more revenue than there are costs. If public savings is ever negative, that means the revenue they're generating with taxes is less than the amount that they're spending. And there we would say we have a deficit. So the way that we identify a budget surplus or deficit for the government is just looking at this public savings value. We're not looking at national savings, right? We're thinking about budget surpluses or deficits are specific to the government, right? So there we're looking at kind of public savings. Okay. Any questions on that one before we keep moving here? All right, so I've got a little bit more of a difficult one in the next slide. So we'll kind of stay here and work through this. So I kept a lot of these values the same. So let's say GDP is equal to 800, consumption is 400, taxes are 200, transfer payments are 300. But now let's say I tell you what national savings are, and it's negative 200. Okay. So if this was the case, right, how am I going to solve this, right? I'm asking you kind of what private and public savings are. Well, private savings, we have all the information that we need, right? We said private savings is just our GDP or Y minus consumption minus taxes plus these transfer payments. Oh, sorry, transfer payments. I'm looking at the value and jumping the gun. So we had what? 800 minus 400 minus 200 plus 300. So there I get what? I think negative 100 if I'm doing math in my head correct. So we've got, nope. So we have what? 600, 200. So I have what? 500. All right, that would be the level of my private savings. So what I don't know is government spending here. All right, so when I'm trying to find public savings, that's going to be taxes minus government spending minus these transfer payments. I don't know what public savings are. I know taxes are 200, and I know that these transfer payments are 300. Okay. So what I need to find is public savings in order to figure out what government spending is, or I need to figure out what government spending is in order to figure out what public savings are. Right? So this is where we can use this idea of national savings is equal to my GDP minus consumption minus government spending. I know three of these things, so I can solve this equation for the one that I don't know. So I was told national savings were negative 200. I know my GDP is 800. I know that consumption was 400. I don't know government spending. So if I rearrange this equation a little bit, I add G to both sides. I'm just going to do the math here. So this would be 400. And then going to add 200 to both sides. And I get government spending is 600. Okay. Any questions on that before we keep moving? Okay. Make sure I've got. So if that's government spending, now I can go back and calculate what my public savings are, right? So now I would have what? My public savings is kind of the second part of this, would be 200 minus 600 minus those transfer payments. So I'm at what? Negative 700. Okay. So that should be the level of public savings. And then I calculated private savings already were 500. Now, one way to check myself on this is what should be true is national savings is equal to private plus public savings. Well, I now have those two values. So we said private savings were 500. Public savings we found was negative 700, which sure enough, that gives us the original national savings that we were told was negative 200. So we didn't make a mistake in our math here, right? Because no matter how we calculate national savings, whether it was Y minus C minus G, we get the exact same value if we take public and private savings and add them together. Okay. So this is where the question earlier, this would be probably not a fill in the blank question. This would likely be a what is the level of public savings, a formula-based question or numeric question. Any questions on this one before we keep moving? Okay. All right, so we're going to switch gears a little bit here and move to thinking about the market for loanable funds. So we have investment in physical capital, and we have this way to calculate savings. So what is going to be the result of this in terms of we know that some individuals are going to want to take out loans or borrow money. Other people are willing to invest or kind of give out those loans. So what is the equilibrium amount of loans we're going to see in the economy, and what is the equilibrium interest rate? So people who are saving money, right, or putting their money into investments, they're supplying loanable funds. Okay. So this is typically, you can think about this as like individual consumers. They're buying mutual funds, they're buying stocks, they're putting money into bonds, right? And so they're going to be the ones that are providing the supply of funds. So this gets kind of flipped from a lot of the models we're looking at because consumers here are actually supplying the money. This could be the government, right? They're willing to kind of loan out different amounts of money to individuals. If this is individuals who are um, wanting to purchase kind of a bond, right? They're the consumers, and the public government is giving them this bond. They're kind of the lenders or the suppliers. So it can come from consumers or the government, but these are people who are supplying the funds. We then also have people who want to take out these loans. Typically, the easier way to think, sometimes it's consumers, but primarily we're going to think about these are businesses who are trying to generate money that they can invest in the capital. So they're demanding loans. They're demanding these loanable funds, right? So how are real interest rates determined, right? Well, this is the idea where there's incentives work in opposite directions, right? So interest rates are essentially the price of a loan. So if I'm supplying the loan, I want interest rates to be higher because that means whoever I'm giving the loan to is going to have to pay back more in the future. Or essentially, when I'm putting money into something, I'm saving, higher interest rates mean I'm going to get a higher payoff. So how are prices going to be determined? Basically, where supply is equal to demand. Well, if real interest rates are now our prices, what's going to be on our y-axis is not a price, but it's the price of savings, the real interest rate. Now, for individuals who are consuming, right, they're demanding these loans. Well, for them, lower interest rates are actually better, right? I'm going to want to take out more loans if his interest rates are lower because I'm not going to have to pay as much to take out that loan, right? If I'm supplying it, I want the kind of price to be higher. I'm receiving more money. If I'm a demander of loanable funds or I'm investing this money by taking out a loan, I want the real interest rate to be lower because it means I'm going to have to pay less in the future for this loan. Okay. So we're going to have an equilibrium, just like a typical any other market. It's going to be where supply is equal to demand. It's just now we're looking at the equilibrium amount of loanable funds, or you could think about this as like the number of loans, if that's easier to think about it. And then kind of our real interest rate, that's going to be our price of these loans or these investments, right? Kind of thinking about from either the suppliers or the demanders for loanable funds, not like standpoint, right? How we're kind of viewing this. So we can identify our equilibrium. So what's going to be some things that could shift our supply of loanable funds or our demand for loanable funds curves? So some of the things that we're going to see shift supply, and these get kind of hard to think about. So this might be a good thing where having notes on this will help you on the exam, because I won't necessarily just tell you supply is increasing or decreasing. I'll give you a change, and then you'll be expected to know if supply is increasing or decreasing, and then what the resulting impacts would be. So if we have an increase in income, so consumers have more money, yes, that's going to increase consumption. But remember, we don't spend every dollar we make, right? Marginal propensity to consume is not one, so part of that's going to go into savings. So increases in income should increase the savings of individuals. That should increase our supply curve or shift it to the right. If I expect future income, it's a little bit different. Because if I think I'm going to have more money tomorrow, right, I might actually spend more today. Our marginal propensity to consume might go up because I'm acting today as though I already have that income. I'm not worried about having money tomorrow, so I'm going to save less. So if we expect higher income in future periods, we actually see the current level of savings go down, right? I'm not like protecting myself from the future because I think I'm going to have even more money in the future. Anything that would increase consumption, so anything that's causing that marginal propensity to consume to go up from our earlier modules would also decrease savings. I likely won't give you kind of examples of this. We'll kind of primarily focus on these and then the subsequent ones I'm about to show you. So that was like private investment, public investment. Sorry, I shouldn't say public investments, but like public savings, right? People who are kind of giving out these loanable funds. If government spending increases, they're essentially spending more money. They have less available funds to give out to other individuals. That should decrease public savings or decrease our supply curve, right? They're spending more money, they have less available funds to loan out, and so we're going to see public savings decrease. Part of our national savings was public savings, and so we'll see a decrease in the supply there, or a shift to the left. Okay? Now, if consumer taxes go up, and this is also one that's a little bit tricky, but if I am spending more on taxes, right? They're taking a higher proportion of my income. What might I want to do, right? I'm going to actually want to increase my savings, right? Because if buying something, higher taxes now, you can think about if the sales tax goes up, it's more costly for me to consume. So I'm less likely to take part of my income and consume. If I have that and I don't want to buy products with it, what am I going to do with that income? I'm going to save it. So increases in current taxes will actually increase current savings or shift our supply curve to the right. They're going to go up, right? What do I want to do today? Well, if I think the sales tax is going to be higher tomorrow, I'm likely going to want to increase my consumption today. Now, this is one where I won't give you an example like this on the Quizzer exam because you could argue that you know, I could just tell you what this is, but that's not actually what lines up with the real world. Because if I think there are going to be higher taxes tomorrow, yes, I might want to increase my consumption today to avoid those taxes. But I also think, well, if I'm going to have to buy, like I have to buy food and housing, and if the taxes on those are going to get higher in the future, I might need to save more today to be able to pay for my future consumption, right? So really, we could see consumption and savings currently go up or down from these tax expectations. It would really matter how much those future expected taxes are increasing by. So I'm not going to kind of give you examples of this. I'm just mentioning it to know, like in the real world, these tax expectations um, could influence our supply curve. Right? So if you want to like not worry about this one, you could cross it out in the slides. I'm not going to kind of give you examples of this. Okay. So if those are things that shift our supply curve for loanable funds, we also have things that are going to shift our demand curve, right? So what are some consumption shifters that we could see? Well, oh, sorry. What are some demand shifters we could see? Anything that kind of increases consumption, right? So if I think about I want to consume more today, I might actually have to, excuse me, take out more loans, then my demand might increase, right? If I think I'm going to have higher future profitability, so as a firm, right, the individuals who are demanding loans to invest in the physical capital, if I think I'm going to have more profits tomorrow, I can then pay off these loans. So if I think I have more money coming in tomorrow, I'm more likely to borrow money today or increase my demand, right, for current. investments or current, I shouldn't say investments, current loans to then make investments into physical capital. Improvements in technology, kind of a similar sort of idea, right? I think that's going to result in higher profitability, so I would increase my demand today. Right? And then if business taxes go up, if current taxes are higher, so this isn't expectations, this is current taxes on businesses, well, they're going to have less available funds, right? So if I have less available funds to actually purchase these loans, we're going to see that demand decreases. Okay. And then if my cash flows are higher, you can think about this as basically I have more available funds currently. I can buy more loans to then invest in the physical capital. So higher cash flows means my demand is also going to increase. Okay. So these are kind of the factors that we could think about that shift supply and demand for loanable funds. Excuse me. So how do I find these equilibrium real interest rate levels, right? Well, it's basically where supply is equal to demand. So we'll work through a couple of different examples here, and I'll probably go through these a little bit quick, just kind of based off of where we're at with time. But if I'm thinking about the loanable funds market, and this is kind of the amount of loanable funds, or we said we could think about this as the number of loans. And here I've got my real interest rates. If I started out with a scenario where I've got my supply of loanable funds, I've got my demand for loanable funds. We started out with this kind of equilibrium amount, and here was going to be, I think the way that I notated this slide was like a italicized R. So if we see that the government gives investment tax credits, so they're giving, oh, so if they're giving businesses tax credits, essentially what that's doing is it's lowering business taxes. So if I see a decrease in business taxes, we now see that companies have more available funds to take out loans. We should see what an increase in the demand for loanable funds. Companies have more funds available to then go out, uh, pay for or purchase these loans. And so what's that going to do to kind of current interest rates? That should increase our interest rates, but then also increase the number of loanable funds that we see out there in the market, or see an increase in the number of loans that are taken out, if we want to think about it that way. Okay. Any questions on that idea? So on the flip side, right, what if I had kind of a similar thing? So we saw that interest rates and loanable funds go up. I'll put this on the same graph. We could draw it out, but for the sake of time, let's say instead I had companies expect economic downturns. Well, economic downturns mean they're going to expect lower profits. So if I think I'm going to have lower profits, I have less available funds to kind of make, I'm not going to have as much money to pay off these loans. I'm actually going to see a decrease in the demand for loanable funds. So kind of this is like scenario 3. So what is that going to do to my equilibrium loanable funds and my equilibrium interest rate? It's going to instead cause them to decrease. So here's, it's very similar to other models we looked at. It's just shifts in supply and demand. Okay. Any questions on this idea before we keep moving? I want to make sure I pause here. Like I said, I think this is easier, so I'm trying to save a little bit more time for some things that are a little more complicated. So we could also do things that shift supply. So I'm going to actually take the examples in the slides and do some simultaneous changes. Okay. So in doing that, we'll answer the questions that we have in the slides, and then I'm going to add something in because I could give you simultaneous changes on the quiz or the exam. So just like any other example that we've looked at, if I have simultaneous shifts, my suggestion would be to draw these out separately. So let's instead assume that a budget deficit occurs. So if we have a budget deficit, that means that essentially government spending is high, right? Government spending is increasing. So I should have probably said here on the slides, assume the budget deficit is going up, right? We're seeing the government spend more money. They have less funds available to give out these loans. So we should see this decrease in our supply curve, right? Which remember, decreases in supply are shifts to the left. I said one way to think about this as anytime something shifts to the left, we're getting closer to zero. So it's a decrease. So from our initial equilibrium point, our initial interest rate, and our initial amounts of loanable funds, or once again, maybe if it's easier for you to think about the number of loans, after we see this decrease in supply, what is that going to do to my equilibrium interest rates and my equilibrium amount of loanable funds? Well, this decrease in supply caused interest rates to go up, but it caused my loanable funds to go down. Okay. If simultaneously I also had, let's say I had an increase in current income, right? So what would an increase in current income do? Well, if we started out, here was our initial equilibrium, sorry, F, equilibrium loanable funds and our equilibrium interest rate. If we saw higher levels of income, yes, people will consume more, but they don't spend every dollar. Part of that is going to, marginal propensity to save. So we should see that the demand for loanable funds or the amount of money that people are investing are willing to um, the amount of money they want to put into um, sorry, I don't want to do a increase in demand here. So what did I have in the so we did supply. I want to do a demand shifter. Sorry, not income. I already did a supply shifter here. I want to do something like our example earlier. If business taxes go down, then companies are going to have more available funds. They want to make these investments, so we would see the demand increase. Right? So what would that do? That increases our interest rate and increases that equilibrium amount of loanable funds. So if I were to kind of stack these two, right, I see that this demand increase caused my real interest rate to go up, but the number of loanable funds to also go up. So here, if I'm thinking about what would the total effect be, well, I know that the new equilibrium level of interest rates will be higher because both of these changes are causing interest rates to go up. But in terms of the equilibrium amount of loanable funds, the answer is it depends. We can't determine. Right. Now, how could we determine what the effect is? I would have to give you an additional piece of information, which I think in the example up here, we said we had a increasing budget deficit, right, which was causing this shift in supply. So what I would have to tell you is something like the following. Assume that the change from this deficit is causing a larger change or a larger shift than this decrease or this change in business taxes. Well, if that's the case, which of these effects are larger? Well, it doesn't matter for the interest rates, right? It doesn't matter which one's larger. We know interest rates are going to be higher. Oh, I'm glitching out here. Hold on. Okay. However, for the loanable funds, if this effect is larger, we know this is the change that's going to like win out or the larger change that will dictate what the total effect is. So here, if this is the case, we see that the total effect would be, yes, interest rates go up, but loanable funds must be going down. Okay. Now, I would solve these simultaneous change models like this because similar to the other one that we had like in module 6, if I draw this on the same graph, it depends on how large I draw these changes. So I'll try to give you kind of an idea about why that's the case, just to kind of stress the importance of drawing these out separately. So let's say I had these simultaneous changes. Right? And this is my kind of initial interest rate and my initial equilibrium loanable funds. Now I have to remember what shifts I did. I did a what? Supply decrease and demand increase. So let's say I had this supply decrease. Right? Well, I also had a demand increase. Okay. Well, if the demand increase in our earlier example, we said, what if it's less than the change in the supply curve? So here I've got a really small change in demand relative to that increase in supply. My new equilibrium, right, is where the new supply and demand curve intersect. We could see that the number of loanable funds goes down, but the equilibrium interest rate should be higher. Okay. That was kind of the scenario that we had in the previous one where we stacked them and I told you which one was larger. So this would kind of line up with what I told you. Now, if the opposite was true, that this change in demand was actually larger than the shifter in supply, if I drew it out this way, right, a very large change in demand, where is my new equilibrium? Well, it's still at higher interest rates. We said it doesn't matter which shift is larger. We always knew they're pushing interest rates in the same direction. But loanable funds, if the demand shift is larger, it'll look like loanable funds went up. So there, the relative size of the shifts changes what's going to happen to that equilibrium amount of loanable funds. And a different combination of supply and demand shifters could make the interest rate indeterminate. So I think I'll have an example here of that in just a second. So this is where I wouldn't put them on the same graph because there it depends on how I draw it. And when I say it depends on how I draw it, it's really which of these effects was I drawing to be larger? All right. So I think breaking this down into two different graphs, thinking about the directional changes of each one of those shifts, whichever shift you're told is larger, that's the impact on the equilibrium that's going to overshadow the other change, if you want to think about it like that. Here, let me readjust my connection here. So hopefully we're not getting as many of these glitches in there. Does that make sense? Or any questions on that before we keep moving? Okay. So let's think about a different scenario just to kind of get a little bit more practice. Could you have simultaneous? So if you could have them, um, in which case I wouldn't give you an example where we're doing that, but really there it'd be the same idea. Like if so one thing is shifting supply up and one of it's shifting it down, you would have to know whichever is larger, and that's going to be like your total impact, like your total effect, right? Um, I likely won't do something like that. Usually these simultaneous changes, I shouldn't say usually. I will always, with these simultaneous changes, give you one change in supply and one change in demand. Okay. Any questions on that? Or if I didn't, I would give you these simultaneous changes in supply that would both be pushing supply in the same direction or both be pushing demand in the same direction. So there wouldn't be like indeterminate answers there. So let's instead, I think the other slide I've got, what if consumption taxes are increasing? Actually, is that what I did in this previous one? I think so. I'm kind of giving you different examples here. No, I did business taxes. Okay. So let's think about instead, what if I had a market that was in equilibrium? And I've got my original equilibrium amount of loanable funds or the equilibrium amount of loans, if I want to think about it that way. If I see um, hold on. Yeah, so I've got an increase. Well, if I have an increase in consumption taxes, that means that it's more costly to consume, so I'm more likely to take more of my money and save it. So that's going to cause an increase in savings or an increase in the supply of loanable funds. So what does an increase in supply look like? It's actually going to be a shift to the right, right? Increases moving away from that 0 point, shifts to the right. So what impacts is that going to have? It's going to increase my equilibrium amount of loanable funds, but decrease my interest rates. All right. So here I've got this change is causing my interest rates to go down, my equilibrium amount of loanable funds to go up. Okay. Now, if at the same time I have a simultaneous change, so here we kind of started out with our equilibrium point. If instead I have a decrease in what example haven't I given you yet? Let's say I have lower cash flows, right? Well, that means I have less available funds to kind of pay off these loans. So if I'm the person who are demanding or taking these loans out, that's actually going to cause a decrease in the demand for loanable funds. What impacts will that have? Oh, no, sorry. Let's do the opposite to make this a little bit more interesting. Um, sorry, I want to give you just different, I want to give you just different examples so that we kind of have more combinations. So let's say instead, sorry, I'm going through this. So I've got my equilibrium interest rate. I've got my equilibrium amount of loanable funds. So we started out here. Let's say instead that cash flows or profits, you could think about it this way, either way, profits or cash flows are increasing. So I have more money to kind of pay off these loans. I'm going to demand more of them, right? Or the increase that we see in demand is going to go, or the change in demand we're going to see is an increase. So what is that going to do? It's going to cause my loanable funds to increase, but also my equilibrium interest rate to increase. So if that's the case, right, this increase in profitability caused demand to go up, which caused my real interest rates to go up, but my loanable funds to go down. Okay. So if I have these things happening at the same time, what is my total effect? Well, they're pushing, sorry, I drew my arrow on here, right? This is actually causing loanable funds to go up. So they're both causing loanable funds to go up. So I can definitely say those are going to increase. But in terms of interest rates, they're pushing interest rates in opposite directions. So I don't know, right? Here, once again, I'd have to tell you about which of these shifts was actually larger. So in this case, if I told you that the change caused by this increase in profits was larger than the shift caused by this increase in consumer taxes, then you know this is the effect that would kind of dominate. And so the total effect, if I told you which of these was larger, in this case, I'm telling you kind of that profit change was larger than that consumer tax change. There we wouldn't have an indeterminate answer. If I know the relative size, I can say what's going to happen to my new equilibrium interest rate. But if I didn't tell you, the answer would be I can't determine or indeterminate. Okay. So I wanted to do the reason why I changed this is because you can see sometimes it's the interest rate that is indeterminate, or like in our previous example, sometimes it's the loanable funds that's indeterminate. It really just, matters what the combinations of these simultaneous shifts are. Okay. Any questions there before we keep moving? Okay. Okay, so what's in the chat here? Yeah, I think I already answered that one, yeah. So let's go back. So we worked through kind of these simultaneous change. Here's kind of a summary of all the different combinations we could see, the impacts of just a demand shift, just a supply shift, or the combination of the two. Okay. So let's switch gears a little bit here, and I'll come back to this idea of simultaneous shifts when we look at the daily quiz for today. But for now, I want to think about how do we calculate present value. So if I'm thinking about making an investment or kind of taking out a loan, what's the present value of that investment? So we're going to think about interest rates are going to change the value of this investment. So this is the idea if interest rates are higher, when I invest into something, that means that in the future, I'm going to get a higher payout, right? We said when things are at a higher risk of default, right, I'm going to require higher interest rates. I need a higher payment in order to be convinced to give that loan out, right? Or to make that investment. So when should firms be investing into projects? If the present value of that investment is greater than the current cost, right? So when we're thinking about the present value, what is the value of an investment today? We can first think about it, what's the future value? So whatever I invest today, that investment is going to grow every year at a rate of 1 plus the interest rate. Now, if I'm thinking about that payoff doesn't come just in 1 year, it comes 10 years out, well, then every single year I'm going to be earning whatever that interest rate is on that investment so that my future kind of payout is going to be larger. But if I rearrange this equation, I can also think about this as, yes, I'm going to be receiving a higher amount in the future. However, the current value, if I wasn't making the investment, I could be, if we want to think about what's happening over time, is not just that I'm getting paid for making this investment, but prices are going up, which essentially lowers, right? Even I'm making $100 10 years from now, it's going to be worth less today, right? Because prices going up makes that future payoff a little bit lower. Okay. So I can kind of think about in this equation, R is going to be the decimal form of the interest rate. So it won't be 7. If it was 7%, it would be like 0.07. Okay. So I can then think about what's going to impact my decision to invest, right? Well, the first thing we could think about is if interest rates are higher, right, then I'm only going to invest if the present value is greater than the current cost. Right? So whatever price I'm paying for this investment today, if the present value of the future payoff is larger, I should be investing. So how can I calculate the present value? We take the future value or the payoff in the future, discount it by whatever that interest rate is, however many time periods we want to go out. So we can think about as the interest rate goes up, that denominator is going to get larger. The same value in the future is actually going to cause higher present value, right? So if R goes up, the denominator is smaller. Sorry, the denominator is larger, which makes our present value actually lower. So I might have said that. Let me say that again. So if the interest rate is higher, right, that means that we're discounting the future value by even more. So when the denominator is higher, we're dividing by a larger value that decreases the kind of current value of that investment. Okay. So less likely to invest there if interest rates are higher. And that kind of makes sense, right? If I'm taking out a loan today, I can use that funds to invest in the physical capital, but higher interest rates means I'm going to be paying more for that loan, right? And so it's going to really make the future payoff, right? If I have to, the future payment is actually going to be larger the larger that interest rate is. So kind of the current value would go down. If the current value of that investment is lower, it's more likely to be less than the cost, which would be less likely that I'm going to invest. Now, some other things that could change. What if the length of this project increases? So I don't get this payoff until down the road, like a longer, instead of the next 5 years, it's not until 10 years down the road. Well, once again, I only invest if the present value of that investment is greater than the current cost. If n goes up, when we take something to a larger power, that increases its value. So increasing that denominator decreases our fraction, lowers the present value, making it less likely to invest in that project as well. Okay. Because current investment, right, I'm only be able to do that by taking out this loan. Higher future time periods means I'm going to have to pay more for that loan over that time period, or that 10 years or 20 years. Or we said the longer the time period, what do we say is true about default risk? Default risk is higher, which means I'm going to have to pay a higher price or kind of someone would require higher real interest rates, right? So both of these things, interest rates or the number of time periods that increase, decreases the present value of investing into a project or makes the loan more costly, making it less likely we invest. Okay. So let's kind of go through a thought experiment here. And then I think we'll have, yeah, plenty of time to go through that quiz. So should I invest into a project? So if I take $200,000, right, and I want to invest it into a project, and it's going to pay out $50,000 over the next 5 years, right? Well, the total payoff is going to be 200,000 plus 50,000, right? Well, no, because when I'm getting those payoffs in the future, right? I have to discount those future values, right? So if interest rates are 10% or in decimal form 0.1, every year I get paid 50,000. To get the present value, I actually need to discount it. So when I get $50,000 tomorrow, here would be kind of the discount. 2 years from now, I would discount that amount, 3 years, et cetera, et cetera. Right? So if I do this calculation, I get that the present value of this project is not 250, it's only about 190,000. So you can kind of think about, well, if instead my payoff is not 250 and it's 189, if the current cost of that project is 200,000, without discounting, I might think, well, I should invest in this project. But after I discount those future payments or the future payoff of this investment, the actual present value is less than that current cost of 200,000. So no, I shouldn't be making that investment, right? So in this example, no. Once I look at the present value, I shouldn't be making that investment. Whereas if I don't discount those future payoffs, I might think that yes, I should make it. Okay. Any questions on that idea before we keep moving here? So shouldn't the formula be 0.1? Oh, yeah, I had this here. I think when I did the math, I probably used 5%. So let's do, no, this should all be, you're right. Thank you for pointing that out. I had the original amount as 0.1. There we go. That should line up with what I told you, right? Now, what if instead the interest rate is 5%? So instead of 10%, it was 5%. Will this make it more or less likely I invest? Well, if instead this interest rate is lower, right, what's that going to do to my denominator? It's actually going to decrease it, which means future payoffs are discounted less, right? Dividing by a smaller value would increase the present value of each one of these payoffs. So it should increase this value, making it more likely it's greater than that initial investment of 200,000. So that should increase the likelihood I'm making this investment. So I said do this work in class. It'd basically be the same thing, but instead of 0.1, we do 0.05. Okay. So I'll kind of show you an example of this. Let me make sure. I think I had a lottery example. Yeah. So let's go here. So when I said do this work in class, I kind of talked through it, but if I'm thinking about present value and I'm thinking about it's the future value over 1 plus that interest rate to the n, it doesn't matter how many time periods I'm looking at. If that interest rate goes down, right, and I only invest if the present value is greater than the current cost. If the interest rate is lower, I'm discounting fewer or future values by less. If the denominator is smaller, that increases the present value. If I'm increasing the present value, it's more likely that it's greater than whatever the initial cost is, which makes it then more likely I'm going to invest into that project. Right? Any questions there before we keep moving? So looking at time, I want to make sure we have enough time to work through the daily quiz. If we have enough time at the end, I'll kind of return to this lottery example. So it's kind of just a fun example. And thinking about like when I have payoffs, usually these like if I do like the Powerball, they usually tell you you can take a certain amount today, or we'll kind of give you a payoff, for the next 30 years. And then you're kind of thinking, okay, is it better to take the initial payment or to take out this payment for the next 30 years? you would basically just be using this kind of discount formula to see is the present value of those future payoffs less than or greater than if I just take the lump sum. So it's just different calculations. It's kind of a fun example, but I'm not going to kind of ask you questions over lottery examples. So instead, we'll kind of use our time to be a little bit more efficient for that fourth quiz and for the exam. If I got a little bit of time at the end, maybe I'll kind of show you kind of fun example in Excel with that lottery. And if I don't, maybe I'll start kind of review, just kind of showing you that example and revisiting this idea on Thursday, thinking about it in the context of present and current values, or present current, uh, current and future values. So let's look at this first question and think about if I expect to have more income in the future as a consumer, and we have a simultaneous change of increases in firms' cash flows. What's going to happen to that equilibrium interest rate and what's going to happen to that equilibrium number of loans? So if we work this out, right, this is where we've got simultaneous shifts. My strong suggestion would be to do these changes interest rate and the equilibrium loanable funds. So if I have an increase in the expected future value, so this was the idea. If I expect to have more money tomorrow as a consumer, right, I don't feel as though I need to save more today, right? I'm more likely to spend money today because I think I'll have even more money tomorrow. So I'm not worried about saving as much today. So if I'm not going to save as much today, what I would actually see is a decrease in our private savings, which was part of our kind of supply of loanable funds. So a decrease in the supply, it's going to look something like this. So what cost or what change was that having on our real interest rates? That was causing so this decrease in savings or supply, sorry, of savings was causing real interest rates to go up, but loanable funds to go down. Okay. Now, if at the same time, I have another shift, which was increase in cash flows. So we said if I have an increase in cash flows, that means that we have more available funds to invest, right? Or to kind of pay off these loans. So I'm going to see an increase in the demand for loanable funds, which does what? Increase the amount of loanable funds and increase our interest rates. So if this demand increase causes interest rates to go up, but the amount of loanable funds to also go up, here the total effect would be, we know interest rates are going to go up, but loanable funds, we don't know. Okay. So there it should be that interest rates, the new equilibrium interest rates will be higher, but the number of loans or the loanable funds, we can't determine unless I was given more information about which of these changes was larger. Okay. And I would practice these. So I've given you some examples today. I don't think we've done every combination of simultaneous shifts. Like another one that would be good to go through is see something. What if this was like in the opposite direction? So we had decrease in cash flows, lower expected income, so that I get kind of this combination. Think about how would that influence those equal. Actually, the one I don't think we worked through, if you want to work through this one on your own, try to do decreases in both supply and demand and see kind of what impact that has. But I could give you any combination, right? There's four different possibilities of these simultaneous shifts. So increases in both, decreases in both, increases in supply, decreases in demand, or decreases in supply, increases in demand. And I have them summarized in that one slide, but it would be good to be able to work through all of those in this manner. And then when you have answers that are indeterminate, an additional follow-up question could be, I tell you which of these changes is larger, whichever change is larger, that would be the one that kind of dictates that effect for the thing that was indeterminate without having that additional information. Any questions on that one before we keep moving here? Okay. So, question two, what would make it more likely I want to take a loan out to invest into a project? So, when we're thinking about when do we invest, it's if the present value is greater than the current cost. So, how did we calculate the present value? It was kind of the future value of this investment divided by 1 plus the interest rate. Now, once again, if this is 7%, we would put a 0.07 in here for the interest rate. Right? In fact, if you make the mistake, this number is going to be astronomically lower. It won't really make a whole lot of sense. So what's going to make it more likely I invest in this project? It's going to be things that increase that present value. So what would those things be? So if I see an increase, right, in the return on investment or an increase in my real interest rates, right? What actually, sorry, increase in the return on investment. Oh, sorry. So did I do an interest rate one here? No, I hid this one. Sorry. So if I have an increase in the return on investment in the future, or this future value, the future payoffs go up, that would increase my present value, making it more likely, right? I invest, right? When this is larger, I invest. So anything that increases my present value, it makes it more likely I invest. If instead I saw an increase in the number of years that it would take for this thing to, this investment to pay off, we said an increase in the number of years, or I didn't give you an example here, but something that would increase interest rates, increases the denominator, which decreases the fraction, lowering that present value, making it actually less likely. So an increase in the number of years would actually make it less likely I make this investment. Now, here's where I could do this combination of the two concepts where we think about equilibrium interest rates because we know interest rates impact the present value. So what if I had an example where I said, I have an increase in consumer taxes, right? So if I see an increase in taxes, right, what is that going to do? Well, we said people are less likely to spend their money. So that's going to cause the amount of savings that, the money they're putting into savings to actually increase. What is that going to do to equilibrium interest rates? It's going to push them down, right? So to draw this out. So if I have interest rates are going lower, if my denominator is smaller, that actually increases the present value, which would actually then make it more likely I make this investment. So I could give you a change that would either shift supply or demand. You would then identify, and I won't do a simultaneous shift when I combine these. I would just give you a shift in one of these. So if the supply of loanable funds goes up, interest rates will go down, which increases the present value, making it more likely that present value is greater than the current cost and more likely I make this investment. Okay. Any questions on that? Now, another example that's not the correct answer here would be if I had an increase in the demand. So if I had an increase in demand, we could kind of draw this out. What is the impacts of that going to be? So if I had an increase in demand, and here we're just going to focus on interest rates. If I see an increase in demand, that increases interest rates. So if I think about my present value formula, if I see increases in interest rates, that increases the denominator, that actually decreases my present value, making it less likely I make this investment. Okay. So there it was what? The things that caused present value to go up or more likely was if that payoff in the future is higher or if we have an increase in supply. And the increase in supply was then caused by that increase in consumer taxes, right? Current taxes. Okay. How do we know the increase in present value relative to the cost? So you don't know if it is higher or lower, but you know that it is, if it's increasing, it's more likely that it becomes higher than the current cost. So I would only ask you about like directional changes, not like a definitive, should I make this investment or not? It's just that if the present value goes up, I know that I am, all else equal, more likely to make that investment. Doesn't necessarily mean that it would make the present value above the current cost, but it's more likely that it would be above the current cost. Does that answer the question that you had? Okay. Any other questions here? All right. So since we have time, and I believe you're seeing my screen here, hopefully, let's think about, I'll go back to this lottery example. So it's kind of interesting to think about, but another way of thinking about this is, so if I take the payout today, right, the amount that the company that I had this, won the lottery from, they'll give me 67.7 million today. However, if I take 2.32 million every year for the next 30 years, what would the total payoff be? Well, every year, right, I'm making 2.32, right? But the actual kind of payout that I'm going to be in terms of um, how much it's growing by would be one plus, what do I want here? So what do I have here? So the payout every year, if it keeps up like with inflation, I had like it'd be 0.05. So every single year, that payoff is going to be a little bit higher and higher, right? However, when I discount those payoffs, I take the future value divided by one plus the kind of interest rate that I'm kind of being that currently exists. I'm then kind of raising it to the power of how many years out it is. I then add up all those values. What I see is that here, if I actually took that payoff with a 7% interest rate, or essentially that I'm discounting future payoffs even more, I get that I'm only getting 50 million. So in which case, I should actually be taking the payout today. Because if I take it out for the next 30 years, the current present value is actually lower. However, if instead that interest rate is kind of 0.05, I can think about, um, so even though this is like the total payoff, this was before I discounted it. So if I don't discount it, I might think, oh, I should take that 2.32 million for the next 30 years. However, when I take those future payoffs and I discount them by that current interest rate, well, there, the present value is actually lower than what that kind of lump sum payment would be. And then I could play around with what if instead the interest rate was, um, what do I have here? So I'm at 0.1. Well, we said if the kind of interest rate is higher, that discounts our future payoffs even more. That should decrease the present value, making it even less likely I should take those kind of future payoffs. And then if the interest rate, or you think about the kind of the inflation rate is even lower, now that makes it more likely I shouldn't take that lump sum, right? Because it's going to cause the present value to actually increase when that interest rate is lower, if we were looking at that present value calculation. So you would kind of use something like this to actually, hopefully make the correct decision and from a lottery if you win it to either take the kind of lump sum payment in the first year or kind of accept these future payoffs. In fact, just to kind of relate this, it doesn't have to be a lottery example. I know in sports this is really common with contracts where you might see really large contracts signed and you're like, oh, this person made 50 million today, but there was like restructuring of contracts. So I think it was Bobby Bonilla, like he agreed to take $1 million over the next like 30 years instead of $10 million in the year. And if you discount all that, the actual present value of receiving all that was actually higher than if you took the initial lump sum payment. So that benefits the team because they don't have to pay as much every year, but it also benefits the player because overall the present value of their contract is going to be higher. So there's different examples where you can kind of see this application of present and future values. So kind of ran out. Right? So we might get done a little bit early today. I think I probably threw in more simultaneous change examples than I was planning on, but I think that's worthwhile in terms of preparing you for the quiz and the exam. So I'll end the recording here, but I said I'd have some time left over to answer any questions that you had about um, the exam or anything kind of leading up for the next few days. So I'll end the recording here. And then I've got